And so why this matters, why you want to start thinking like a CFO, is because making decisions from your financials, this is super important to understand. Making decisions from your financials is one of the first steps that you can take from being an operator where you just sort of own a job to being a true owner of a business. I don't know a single true owner of a business who doesn't get regular financials, make decisions from them, and use them in their business. So it's super important. And so I want to kind of teach you how to think like a CFO. And what it really means is it's asking a series of quality questions on a regular basis in your business. And that first question is, where did the cash go? And how many people get to the end of the year and your accountant says you got all this profit, but you're like, where's the cash? Anybody felt that before? Yeah. So we don't just want to kind of accept that as the reality when you get to, tax time or whenever you're looking at your numbers. You want to start thinking and looking at where did the cash go over the recent months. Maybe you had to take out $20,000 for a big personal expense or to pay your tax bill. Or maybe you've got all this profit on paper, but it's sitting in the banks of your customers in the form of accounts receivable. Or maybe you got all this product that you can't move, so it's sitting in inventory, so it's not available for cash. So once we understand where the cash went, then you can better understand where the cash will flow in the future. And you should always have kind of a rolling 30-day and rolling 12-month cash flow forecast. Obviously, the 30-day cash flow forecast is going to be more detailed and granular because it's closer, in proximity. But having a kind of a 12 months rough idea of where that cash is going to come from and where it'll go to is going to help you sleep so much better at night, number one, and it's going to help you run a better business because in all economic times, cash is critical, but in both challenging economic times and also when businesses are just getting started, it is absolutely essential. Cash is your oxygen. When you run out of cash, you go out of business statistically. So you don't want to run out of cash. So that's why it's so critical to understand where did the cash go. So once you have a grip on cash, then you want to ask which metrics matter. You see, every business has about 3 to 5 key numbers, key metrics that drive profitability and performance in that business. And if you can identify what those 3 to 5 numbers are, create a system for measuring them regularly, and obsess over improving them daily, then you'll pretty much just fall over achieving your goals without even trying. You'll absolutely dominate your competition, and you'll be in the elite of business owners. Almost nobody does this. And I'll give you a hint. The metrics that matter are not what do the coffee pods in the office break room cost. What I've seen so many business owners when we first start talking about this make the mistake of is they look at these little numbers that maybe were part of a personal budget in a past life or in a current life, and they want to control those because they feel like they understand them and can have control over them. And it's not those numbers that matter. It's big numbers, things like what's your payroll as a percent of revenue, or your gross profit margins, your marketing dollars as a percent of revenue, or your ROI, direct ROI on your investment into marketing, or days of expenses in cash on your balance sheet. It's big levers and numbers that you can pull that actually move the needle. Not, you've got to drink a whole lot of coffee to move the needle if you're saving 30 cents per cup of coffee on making those adjustments. Then once you identify what metrics matter, then you want to ask, how do you compare? And that is to others in your industry of similar size. So if you're a boutique retail shop, we don't want to compare you to Walmart. That's not apples to apples. We want to compare, and just like if you're selling T-shirts, we don't want to compare you to if you're an engineering firm. They're not apples to apples. So we want to say, what are your metrics and how do they compare to companies of similar industry and similar size? Because then what you do, and you can do this by a couple different ways. One is there's certain industry publications you can participate in where you pay a few bucks, and then if you give them your numbers, then they composite those all together of everyone who participates and sends them back to you. And then sometimes like we have a whole database of numbers that for our clients that want us to look at this, we can just pull for them depending on the industry. Then you want to see, there's the average and best in class of companies in your industry, your size that are what are they spending on payroll? What are they spending on marketing? What are they spending on rent? How much cash do they have in the bank? How much accounts receivable, payable do they have? And then you map your numbers against that so you can see where the gaps are. And by doing this, instead of just kind of flying blind and making up decisions as you go, you actually have a roadmap to maximum profitability and financial health in your business. And so it's a really powerful exercise to do. And so when we look, I want to just share a little example of this. And so this is actually my mom's children's clothing store. We treated her like a CFO. She bought this a little over almost 15 years ago, and she had an eye for picking out the best clothes. She would go to market. She'd pick out all the things that all the grandmas and moms wanted to buy. You can see the store was pretty packed right when we took this picture, and as a result, all the customers loved the selection. But she was sharing with us when we were at dinner one night that it seemed like at the end of each season, she had to discount way too much stuff to make room for the next season. So we pulled her numbers, and she was doing about $400,000 a year in sales at the time. And it turned out we went to her income statement, and her gross profit on $400,000 of sales was about $50,000 below average. So gross profit is revenue minus cost of goods sold. So she truly was discounting too much to the tune of about $50,000 per year. Then we moved her to the balance sheet, and coincidentally enough, her inventory balance was $50,000 above average. Now, if you've got money tied up in inventory, like I said before, it's not available for cash. And so we helped her set a budget to fix this. So we said, let's just bring you to average, right? We don't need to get you to top 1%. Let's just get you to average. So we said, this is how much you should buy. We looked at what the average purchases should be based on a company her size and said, this is how much you can buy next time you go to market. No matter what the next cute clothing item is, it's going to be the cutest thing in the whole world. Can't buy it. You can buy a certain amount and then that's it. You're cut off. And so fast forward a full year of doing that, we were able to get her to average. So we brought her gross profit margin up by 50 grand, inventory down 50, which meant that was available in cash. So doing that one adjustment and looking at those two numbers led to an annual cash flow increase of $100,000. Like I said, this is a $400,000 business. So, depending on the size of your business, if it's bigger than that, it could be a larger number that's tied up. But if you never look at those numbers, then you never know where the opportunity is for optimization and improvement.